Reliability and diversification. Reliability and diversification. Let's take a look and see where the research team went on this one today. It's a pretty heavy piece. So trading's about accepting risk in exchange for probable profits. That's
okay.
That's a little bit of a stretch sometimes.
Yep.
Perhaps the most long-term successful approach is to diversify, using a mixture of assets so these risks offset each other. I mean, that's one way you can diversify is the underlyings. Another way you can diversify is different strategies. Another way is different durations. Another way is there's a few other things, but let's for now focus on just underlyings. According to probability, the risk, as linearly measured by standard deviation, should reduce by a factor of the square root of the number of independent trades. Cross underlying correlations can eat into those theoretical advantages. So in practice, how does trading using a mixture of underlyings compare to sticking to a favorite? Why do I think this is not going to be easy? We used 15 years worth of data. We used 3 different underlyings, the SPY, IWM, and Qs. We considered trading 45 days to expiration, 16 delta strangles, same as we always do. But here's the thing. We looked at 7 different traders, right? Paying attention?
I'm trying to.
7 different traders. 3 traded one particular underlying. 3 used a buying power reduction, even mixture of 2 underlyings. And then they would, let's see. So for the purposes of the study, we imagined fractional contracts were available. That's to make it all even. And then, 3 who used an even mixture of 2 underlyings, and then 1 who used a buying power mixture of the 3. Let me see this for a second. 1 used a buying power even mixture of the 3. The other one used a buying power even mixture of 2 underlyings. Okay.
Okay.
And then we just fractionalized it. We examined the buying power results as a percentage of the buying power voted, and then we repeated the analysis using 20 and 30 delta strangles as well as 50 delta straddles.
I'm going to take the one with 3 doing the best.
So there were 3 traders who used one particular underlying. Those are guys, they're going to be the losers, right?
I think so.
There are 3 traders who used an even mixture of 2 underlyings. Okay? And then there's 1 trader who used all 3 even. Got that?
Okay. Kinda,
John. He's kind of got that. We're ready for let's get into the.
You got it?
Come on, this stuff's child's play for me. Right? I write this stuff in my sleep. No, all these are hard. So first one we're going to look at is we're going to do 16 delta strangle for all of the above. So we have the SPY, IWM, and Qs. That's 3 traders picking one underlying, right? That's what that is. Then there's the SPY and IWM, the SPY and Qs, and this IWM and Qs. That's the other 3 traders using 2 of the 3, right?
Okay.
And then there's the 3rd trader using all 3, evenly distributed. And those win percentages, they're not, because we've been in a bull market for the last 15 years, those are pretty good.
Mm-hmm.
The average P&L as a percent of buying power, okay, at this point, you're not going to get anything out of this study if you look at it just on paper, other than the 3rd line down, which is the standard deviation, which is your P&L divided by the buying power used. And what you'll see here is those who used all 3 had the lowest amount of risk. That's what that column is.
Sure. Those
who used all 3 also were had a very low CVAR, but again, not the lowest. So we're going to go to the next one, because these are going to be all very similar. We don't have to spend a lot of time on this. You guys can go back to it later on. In the 20 delta, it starts to become a little bit clearer. And in the 20 delta, which is a bigger strangle, you start to see that when you use all 3, you had the lowest standard deviation of risk. And you had a very high win percentage. Right?
Okay.
We're going to go to the next slide. And you also had very low CVAR on these. We're going to go to the 30 delta strangle. When you see this here, you're like, okay, now this starts to make sense because everybody else's numbers get kind of high, but the all 3 stays low. The diversified portfolios are way better than the individual portfolios. And they have a way lower C-VAR. But again, the numbers aren't that crazy on all of these, not that far off. John, next slide, please. The next one's going to be the straddles. When you look at the straddles, which is kind of a little bit towards that, maybe the heaviest amount of risk, you can see that the standard deviation, which is how much risk are you taking? Because this is really the only way we can break this whole thing down. When you talk about risk, the lowest amount of risk is when you diversified into all three. The amount of money you made is kind of the
Which
same.
you would have thought from the very beginning, and that's why you asked.
Which is what you would have thought from the very beginning. We have 6 different portfolios up here, which are not as diversified as all three. SPYs, IWM, Qs, they all did okay. IWM and SPYs, SPY and Qs, and IWM and Qs. All of them did okay, but the standard deviation was the lowest when you used even distribution of all three. It's pretty good.
Pretty good.
Because it's just a validation.
I'm surprised it wasn't more wider. You know what I mean?
I mean, a bigger difference.
Yeah, bigger difference between the two. Yep.
I can understand.
Surprised. Maybe
if you compare it to using any one of the individuals, it's pretty big. When you compare it to the other two, it's kind of not that big.
Mm-hmm.
Meaning the other three, the mixture of the two, it's just marginally better. Diversified traders had significantly lower month-to-month variation in their P&Ls, as well as more mild bad months, as represented by CVAR. For example, the per buying power reduction risk involved in trading a mixture of 3 straddles was slightly lower than using a single 30 delta strangle. So of course, in the end, whichever underlying wound up being the most profitable, at IWM in this case, exclusively was the most overall profitable approach. But we don't know which one that'll be beforehand, of course.
Sure.
So unless you have a strong assumption based on underlying, using a diversified array of trades will help you see more consistent results and more mild losers.
help you see clearly, Sosnoff.